Tax Cut Breakdown: How the Big Beautiful Bill Affects Your 2026 Taxes. Imagine a future where your tax bill could drop significantly, thanks to a piece of legislation known as the One Big Beautiful Bill Act. Signed into law by President Trump on July 4, 2025, this act promises substantial tax relief across the board. However, the extent of this relief varies widely depending on your income bracket, and this is where things get interesting. According to a detailed analysis by the Tax Policy Center, a nonpartisan think tank dedicated to tax policy, the average American household could save around $2,900 in 2026. This is great news for many, but the analysis also reveals a significant disparity. Higher-income households are set to benefit disproportionately compared to their lower-income counterparts. The One Big Beautiful Bill Act not only extends the tax cuts from President Trump's 2017 Tax Cuts and Jobs Act, which were scheduled to expire at the end of 2025, but it also introduces a range of new tax breaks. These include the elimination of taxes on overtime and tips, and an increase in the state and local tax deduction from $10,000 to $40,000. These changes are designed to provide relief to a broad spectrum of taxpayers, but the distribution of benefits is far from equal. The Tax Policy Center's findings show that approximately 60% of the total tax savings will go to the top 20% of households, those earning $217,000 or more annually. For example, a household in the bottom quintile, earning up to $34,600 per year, might save an average of $150, or 0.8% of their income. In contrast, a household in the top quintile, earning $217,101 or more, could save an average of $12,540, or 2.5% of their income. It's important to note that individual tax savings will vary based on factors such as family size, the number of children, which affects eligibility for the child tax credit, and whether the taxpayer can take advantage of the new tax breaks, such as the elimination of taxes on tipped income. But here's where it gets controversial. A recent poll by the Associated Press and NRC Center for Public Affairs found that over 60% of adults believe the new law will primarily benefit wealthy Americans. About 60% of respondents also expect the law to negatively impact low-income individuals. This perception highlights the ongoing debate over the fairness of the tax system and the role of government in addressing economic inequality. Moreover, the act doesn't just focus on tax cuts. It also includes significant cuts to social safety net programs like Medicaid and food stamps. Critics argue that these cuts could exacerbate the financial strain on vulnerable populations, potentially offsetting any tax savings they might receive. So, what do you think? Is the One Big Beautiful Bill Act a step in the right direction, or does it widen the gap between the rich and the poor? Share your thoughts in the comments below. Trump's Big Beautiful Bill: Key tax changes for 2025 explained. Tax reform just got a major overhaul, and it's stirring both excitement and debate. President Donald Trump's so-called Big Beautiful Bill has officially become law, but here's where it gets controversial. The new tax rules for 2025 could either save you money or leave you scrambling, depending on your income, family size, and where you live. And this is the part most people miss. The changes aren't just about lower rates. They're a complex web of incentives, penalties, and hidden traps that could reshape your financial strategy. Let's break down what's in store, and why this might not be as beautiful as the headlines suggest. At the heart of the legislation is a mix of permanent and temporary tax adjustments. For starters, Trump's 2017 tax cuts, which slashed rates for millions of Americans, are now locked in permanently. That means lower tax brackets and higher standard deductions will stay in place indefinitely. But the real fireworks begin in 2025, when new provisions kick in. Certified financial planners like Jim Guarino, a CPA and CFP, warn that, without careful planning, you could accidentally lose out on thousands in tax breaks. Here's what you need to know. 1. The SALT torpedo, a hidden tax hike for the wealthy ***. One of the most contentious changes is the so-called SALT torpedo. For 2025, the state and local tax, SALT, deduction cap jumps from $10,000 to $40,000, but only for a narrow income range. If your earnings fall between $500,000 and $600,000, the deduction phases out completely, effectively creating a 45.5% marginal tax rate. Critics argue this unfairly targets high earners in states with expensive taxes, like New York or California. Supporters, however, call it a necessary step to reduce federal spending. What's your take? Is this a smart fiscal move or a politically motivated tax hike? 2. Bigger deductions for families and retirees ***. Families with children will see the child tax credit increase from $2,000 to $2,200 per kid, a welcome boost for middle-class budgets. Meanwhile, retirees aged 65 and older get a $6,000 bonus deduction, which phases out at $75,000 for singles and $150,000 for couples. But here's the catch: this deduction only applies if you don't itemize other expenses. For many, this creates a choice: take the standard deduction or maximize other tax breaks. As CPA John McCarthy explains, this is a sweet spot for some, but a trap for others if you don't plan ahead. 3. The ACA subsidy cliff, a looming crisis for insurers ***. Perhaps the most overlooked change is the return of the premium tax credit cliff. During the pandemic, Congress temporarily expanded subsidies for Affordable Care Act (ACA) plans, making coverage more affordable. But Trump's bill doesn't extend this relief. Starting in 2026, enrollees earning just $1 over 400% of the federal poverty level, around $103,280 for a family of 3, will lose their subsidies entirely. That could mean a sharp spike in premiums for millions. Tommy Lucas, a CFP, warns, this isn't just a technical detail, it's a real-life problem for families already stretched thin. Should Congress step in to fix this cliff, or is it a necessary correction to prevent oversubsidization? 4. New deductions for tips, overtime, and car loans ***. The bill also introduces temporary breaks for workers in specific industries. Tip earners, overtime pay, and car loan interest are now partially deductible, but eligibility rules vary. For example, car loan interest is only tax deductible if you itemize, and the benefits phase out at higher incomes. These provisions, while small, could add up for certain taxpayers, but they're not a game changer for the average filer. The bigger picture: strategy over static numbers. Financial experts stress that the real impact of these changes depends on your unique situation. Tax planning isn't about picking the biggest deduction, Guarino said. It's about seeing how all the pieces fit together. That means projecting multiple years, adjusting income streams, and even rethinking retirement strategies. For instance, if you're in the SALT torpedo range, delaying income or accelerating deductions might save you thousands. So, what's next? The IRS is expected to issue guidance soon, but for now, the message is clear: this isn't just another tax update. It's a seismic shift with winners, losers, and plenty of gray areas. Are you ready to navigate the maze, or will you wait until it's too late? Share your thoughts in the comments. Do you think the SALT torpedo is fair? Should the ACA subsidy cliff be addressed? Let's start the conversation.